In this lesson, you'll learn what pre-tax income is, what pre-tax profit margin is, why pre-tax income is Warren Buffett's preferred measure of profit, how to use pre-tax income to compare two companies, and what I look for when investing in companies. Pre-tax income, also known as pre-tax profit or pre-tax earnings. It's exactly what it sounds like. It's your income or profit before tax. So how did we get here? If you've been following this course, you will have worked your way down the income statement. It starts with revenue, then we subtract cost of goods sold. This gives us our gross profit, minus the operating expenses, and we get operating profit. If you have debt, you'll have an interest expense. Subtract the interest expense from the operating profit, and you'll get your pre-tax income. According to Warren Buffett and the interpretation of financial statements, this is the number Buffett looks at when calculating his potential return. Why would he use pre-tax income? The main reason is that pre-tax income allows him to compare two investments. Different businesses and investments have different tax implications. By removing tax, Buffett can easily compare one investment choice to another without the distortion of different tax environments. We can compare two companies by looking at their pre-tax profit margin. To calculate pre-tax profit margin, we simply divide pre-tax profit by revenue. If my pre-tax profit is $30,000 and my revenue is $100,000, my pre-tax profit margin is 30%. 30,000 divided by 100,000 equals 30%. What do I look for in companies? It's the same as any other measure of profit. I want pre-tax income to be consistently growing year after year, just like Microsoft, Costco, and Adobe. What I don't want is pre-tax profits to be declining, like GameStop, Walgreens, and Paramount. I also want pre-tax profit margins to be consistent or growing. I don't want pre-tax profit margins to be up and down or declining. Let's summarize. Pre-tax profit is your profit after subtracting all costs and expenses besides tax. This number is looked at by investors because it makes it easier to compare two different investments in different tax environments. To calculate pre-tax profit, we subtract interest expense from operating profit. To compare two companies, we can calculate the pre-tax profit margin. To calculate the pre-tax profit margin, we simply divide pre-tax profit by revenue. When I look for companies to invest in, I want pre-tax profit to be growing over time. I also want their pre-tax profit margins to be consistent or growing. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.